The correlation analysis page is your essential tool for portfolio diversification and risk management. Understanding correlations between currency pairs is what separates professionals from amateur traders, because amateur traders will unknowingly take multiple positions on the same market move. This page shows you exactly which pairs move together, which move opposite, and how to use this information to build better portfolios and manage risk more effectively. There is more information available in the help guide at the top, which will give you a breakdown of exactly how to use this information. Correlation analysis settings allow you to select different markets. You can select from forex, indices, and metals. And you can select the time frame that you want to analyze and the number of periods. So in this example, we're analyzing the 1 hour time frame across most of the stock indices and the major currency pairs. If we scroll down, you can see here we have the correlation matrix. The correlation matrix shows you how much these symbols move together in the same direction. So for example, the US 30 here compared to the S&P 500 has a correlation of 75%, meaning that 75% of the time, these two instruments on the 1 hour time frame will move in the same direction. If you click on an individual correlation square, it will open a chart below which will show you the correlation over time for those two individual symbols. So you can see the vast majority of the time going back over 100 periods, which is 100 hourly candles. This instrument was highly correlated, somewhere between 94 to 96%. And then the correlation suddenly dropped down at 3 o'clock on September the 23rd. This was probably because of the market open, and different stock indices will tend to move in different directions at the open. They then came back into correlation again and now currently sit somewhere around about 90% correlated. If you want to select a bucket or a portfolio of symbols to trade, if you're looking to trade multiple symbols on the same account, maybe with the same strategy, you can use the correlation threshold to identify symbols which will not be heavily correlated. So if you select 30 on the correlation threshold here, what we will find is symbols that have no more than 30% correlation with each other. So for example, down here we have the suggested diversification baskets section. And in basket 1 here, you can see it is recommending to trade oil, the US 30 index, Euro pound, US dollar CAD, and US dollar yen. These 5 symbols together have an average correlation of 13%, meaning that they very rarely move in the same direction at the same time on the hourly time frame. We have another basket here recommended to us, which is the DAX, the pound US dollar, and gold, and a third basket of the S&P 500 and the US dollar Swiss. You can see that the average correlation on these two is 0, meaning that they never move in the same direction at the same time. You can also select your own baskets. So if you wanted to definitely trade, for example, on the Euro US dollar, you can select that and it will then show you all other symbols which are less than 30% correlated with the Euro US dollar. You can then build your own portfolio, in this case of 3 symbols, which you can be confident that if you trade all 3 at the same time and the market moves strongly, you will not get the same moves happening on all 3 of these instruments. This stops you over leveraging on your potential basket of trades or your portfolio of trades, meaning that you would unwittingly take a trade in the same direction on different instruments at the same time. You can adjust the correlation threshold to something a little bit higher, so 60% in this case. And what that will do is it will allow more instruments to be added into these baskets, giving you more opportunities. But be aware that these instruments could move together up to 60% in the same direction at the same time. One strategy that you can use with the correlation analysis dashboard is to select all forex pairs or select all indices and look for heavily correlated instruments. So anything that is highlighted in dark green, which is not the same currency pair. So in this case, as you can see, we have the Australian dollar, Canadian dollar, and the Australian dollar, US dollar, which are 85% correlated. If we click on that, you can see that over time, these pairs become uncorrelated. So what we can do is when we see a correlation drop on these particular instruments, it will be a good opportunity to buy one and sell the other. That way, when they come back into correlation, one of the trades will be in drawdown, but one of the trades will be in profit. And because they were taken when out of correlation, when they come back into correlation, typically you will find that there will be an overall profit on both of the symbols together. You can also do this on the stock indices. So if you select all indices and look at an hourly time period, or you could choose a smaller time period, you can look for instances where we find there are less correlated movements between the Nasdaq and the S&P 500. Currently, they are correlated to 98%, but as you can see here, at some point on the 25th of September at around 8 o'clock, they were uncorrelated to a degree of 73%. So as these started moving out of sync, there were opportunities to buy one and sell the other and wait for them to come back into sync so that you can then make a profit from both symbols together.